This is the Domain Magnate Show, where you'll learn everything you need to know about buying, optimizing, and selling online businesses with your host, Michael Bereslavsky.
Hello, listeners. Welcome to another episode of the Domain Magnate Show. Today we have Jim Mann, Director of Acquisitions at Thrasio with us. Hi, Jim.
Hi, Michael. How are you?
I'm good. Glad to be able to connect. So for those of our listeners who might not be familiar with Thrasio, and that's probably not many of them, but still, how would you give us some numbers, some more details about the company?
Yeah, I mean, Thrasio, we are now probably the largest acquirer of FBA and e-com businesses globally. We started in 2018 with a very simple idea of bringing together some FBA brands, building a team that allowed us to leverage some synergies around skill sets. That allowed us to deliver some pretty amazing growth numbers with the brands we acquired, which in turn allowed us to raise more equity. And if you fast forward just over 2 years, we did 500 million in revenue last year. We're scaling up our team way ahead of where we need to be. So we now have 700 people. We have dedicated teams for SEO. We have a data team, we have PPC, creative, brand managers. And we've built this big engine to drive growth in FBA and e-com businesses that we acquire.
Yeah, that's pretty cool. I'd like to get more into the numbers. So you have 700 people. Where are they based? How many of them are in North America?
We're still very centralized. So the majority of those people are in the US, in Houston, New York, and Boston. The team were founded in Boston. So that's where the kind of heart of the business is. And then we have myself in the UK. We have colleague Sammy running the German team. But the main core of the business is US centric. And then we have specific roles like myself where you need feet on the ground in local markets. So we have in-market analysts for each country. We have an acquisitions and deals team for each country. We have some M&A specialists. We have some finance guys. But the main core of that team is in the US. And then we have offshore for the Philippines. We have a big team of about 80 offshore for customer service in Philippines, and around 90 in Pakistan who are doing all the logistics. So making sure that we have all the inventory in warehouses, whether it's Amazon or 3PL warehousing. And as you'll probably know, shipping this year has been quite interesting. So those guys have been working hard just to make sure that we're getting the best prices. Making sure that we've got inventory in on time. And dealing with the logistics.
Nice. So what do most of the 700 people do?
I'm trying to picture this. So we have, at the heart of the business, we have our brand management team. And those guys are organized into categories. There's a brand director, brand manager, and brand associates. They operate in pods. And so they'll be looking at niches like health or technology. And they are charged with owning the P&L. They're effectively like mini CEOs or entrepreneurs in the organization. So they build a business plan, they sign off the budget to grow. They then work with the data team and in-market analysts to look at opportunities. They'll work with the creative team around the listings. They'll work with the copywriters. They'll work with the PPC team for Amazon PPC. And then we've got 2 teams outside of that, which are, one is direct to consumer. So we're working very hard on building branded websites now. And those guys are driving traffic from Facebook, Instagram, Google, and the usual external sources outside of Amazon PPC. And then we have a VP of retail who is taking our sort of retail-ready brands back out into retail, which is probably a bit counterintuitive for Thrasio, but we're pushing hard this year to go out into retail as well. So we've got direct-to-consumer, retail, and our main e-com engine for marketplaces.
Nice. So sounds like quite a diverse team. And how many brands do you currently operate, and are they all FBA brands?
We have, it's over 100. I know we hit this 100th acquisition milestone recently. I think it's probably 104, 105 now. Let's say 100 brands under management. We made our first 100% direct-to-consumer acquisition recently, and that's definitely a strategic focus this year. We're on target to hit 100 million in revenue on direct-to-consumer, i.e. not on Amazon. And that's going to be a key pillar going forward for the business. So there's a big investment right now in in different traffic teams, Instagram, Facebook, Snapchat, Google, and they're charged with building the direct-to-consumer websites. We're running 20 D2C branded websites at the moment. And then aside of that, or part of that, better said, we are investing quite heavily in affiliates relationships. We're actually acquiring some influencer sites now as well. So the influencer stays on, but we own the site, and that allows us to direct traffic wherever we want to have it to help with the SEO, whether it's our direct-to-consumer website or whether it's on Amazon, sending in signals into Amazon, which the algorithm responds very well to for ranking products.
Yeah, pretty nice. And do you focus on any specific niches, or are you quite broad?
Yeah, we're a broad church. I would say we're a broad church, but there are some things we shy away from. Fashion's a hard place to be. Stuff goes out of fashion by definition every 6 months, if not every quarter. And then shoes, it's very hard with all the variations from a size 6 to a size 14 to manage the inventory on shoes. You have the compound effect of fashion and size variation, which is impossible. And then we avoid stuff in technology as well. It's stuff gets outdated. To be honest, it's a category that's increasingly dominated and very well managed by Asian suppliers direct. So we're moving more towards categories where we can build a genuine brand and a story and differentiate with a premium product rather than a commoditized, Me Too product with technology that can expire within 6 to 18 months. Because in effect, you're having to relaunch from scratch all the time, which is hard work.
Yeah. Right. So you have about 100 brands, and you mentioned half $500 million in annual revenue currently.
Yeah.
Right. And can you tell us the profits also?
I can't tell you the exact profit. We have a very simple business model. And you probably read that we got a $1 billion valuation in August 2020, and this is when the real interest was sort of drawn towards Thrasio. Now, the reason we're able to keep raising money, and we've Josh and Carlos have raised 1.3 billion dollars in the last 6 weeks. And the reason we're able to raise those kinds of funds is because the track record we're delivering continually, and that track record is on our first 80 acquisitions, we grew 156% year on year, and we have to operate at around about 20% EBITDA. So providing we're growing 156% year on year, that's 2.5 times annual growth, and maintaining 20% average EBITDA, we're in a good place, and that's why we keep raising money. So it's a very simple formula. We deliver great growth and profit. That allows our sellers that we acquire to have fantastic and unmatched earnouts. And then private equity are very happy to keep feeding that growth and our acquisition strategy as long as we keep delivering that performance on the acquisitions.
So how much have you raised to date in total? And what's the current valuation?
Total raise, couldn't tell you, but it's around 1.2 billion. Very recently, we've raised 750 and then another 500 just before Christmas. So there's been a very aggressive raise in the last few weeks.
And that's in total, like for the past 3 years or so since you've started, right?
Yeah.
2018.
Yeah. And we're looking to just accelerate the growth all the time. We're ahead of target this year, and we have very aggressive growth targets already. So it's great. It's a good place to be.
Yeah, that's pretty good. And how many deals have you done combined? Like how many acquisitions?
It's over 100. I think we're probably around 100. Yeah, I couldn't tell you exactly.
More than 100.
That we're accelerating all the time. So I mean, our current number of businesses going into diligence is triple what we were seeing before Christmas. So it's great. We have it's an overused word, but we have a massive flywheel going on right now, and there are different reasons for that. There's a lot of people are capitalizing on the COVID bump. A lot of people have seen a massive growth in their businesses last year. There are a lot of people acquiring Amazon businesses right now. So multiples are the best they've ever been. Yeah. Selling on Amazon is getting harder all the time. So whilst everyone's experienced massive growth, or most people experience massive growth, they've also lost a lot of hair in the process. You put that all together, you've got great multiples, increased valuations, a really stressful last 12 months. And you've got a lot of entrepreneurs who think it's a good time to hand it over and let someone else run the business and cash out. So,
yeah, absolutely. And so you've grown to quite a impressive size now. Do you have a special relationship with Amazon? Like, are you able to get things that most Amazon sellers might not be able to accomplish?
Look, we definitely, we have relationships and we have a track record, and one of the big drive, you'll know, Amazon has a lot of bad actors, and there's a lot of manipulation happening on the platform, and we have to act. We have to be good actors, and so I think Amazon respect our team and the way they operate, because we're playing it with a straight bat, English saying, a cricket. We don't do any of the sort of manipulation tactics that they would frown upon and effectively devalue the perception of their platform. We don't have look. Straight answers. We probably have some direct relationships which are helpful, but I wouldn't say we have anything. We still have the same frustrations. Our team still have to deal with Seller Central. We still have the same frustrations any other seller would have. But do we have other relationships that help? Absolutely. Yeah.
Yeah, because Amazon has a reputation now for basically making a lot of ambiguous policies and then one-sided decisions. So if someone doesn't like your account, they might just suspend it. And if we've had many clients who run into issues, even though they didn't do anything, they were good actors, but didn't do anything against policies.
Yeah.
So have you run into some similar issues? Have you had any problems with any of your brands that maybe got closed or suspended? Yeah. So
yeah, all the time. So in the early days, I think our worst suspension was 56 days. We lost a massive account for 56 days. And it was a critical time. Now, on average, we get listings back up within 36 hours. So we have an internal legal team who are very, very, very well paced on, first of all, identifying why the suspensions probably happened. And a lot of the time, there are a lot of tactics going on with, prohibited keywords being put into listings, false trademark infringements. Very easy to take a listing down if you want to play that game. And unfortunately, when you have category leading brands, which we do in most categories, you're always going to be under fire. So, our team are very much in that and living it every day. And as a result, we get listings out very quickly, but when we don't have any way of avoiding that. That's part of doing business on Amazon, unfortunately. Yeah,
that's great. So you basically figured those problems by going through them and handling things as they come up.
Yeah. We got over 15,000 SKUs now, and so there's not a lot that the brand directors or managers haven't experienced, with that many SKUs under management. So you just have to go with it. It's part of running. No business is easy, and running a business on Amazon is just running a business like it is anywhere else. You have day-to-day things to keep you on your toes, and bad actors doing black hat tactics to try and get you suppressed is day-to-day in the ecosystem, unfortunately.
Yeah. And so Jim, tell me a little bit more about your criteria. How do you pick businesses you buy, and also how do you evaluate them?
It's very simple. Coming back to what I was saying earlier, we have to deliver massive growth, profitable growth on any brand we acquire. And as long as we keep delivering that, our sellers get fantastic exits and earnouts, and private equity keep giving us money to carry on with the same model. So coming back to my role in leading up acquisitions here, we offer on about 10 to 20 of the businesses we look at. And what we're looking for is a business or a brand that we see that when we put our team of 700 people, unlimited cash flow, and marketing expertise or operational expertise that probably no other team does have on Amazon to grow brands. And if we see that, we'll say to the seller, look, this is what we think we can do, and here's what we're willing to pay, and here's what your exit structure would look like. And we look to close the deal with them. But we only see that on 10 to 20% of brands we look at. So in short, we are looking for brands that we can invest and scale profitably and aggressively in the shortest time as possible.
So what's the minimum maximum in terms of revenue that you look at, or profits?
There's no maximum. We're looking at $100, $150 million revenue businesses now. At the other end of the scale, we want $300,000 of EBITDA in the trailing 12 months. The cost of acquisition has some pretty high fixed costs. The legal transaction
Mm.
And then, so we're looking at two things. We're looking at the trailing 12 months profit. We're looking at the growth opportunities in the category or the brand. And then we're looking at the operational cost of that brand. So $300,000 of trailing 12 months profit across 50 SKUs is not something we want to go near, because we're having to manage PPC campaigns on 50 SKUs. So the operational cost of 50 SKUs is very different to the operational cost of 5 SKUs doing the same level of profit. So revenue concentration across less SKUs is definitely more attractive to us.
Yeah, it's similar to us, even on a smaller scale. When we look at businesses and websites to buy, we have to look at bigger sites, because the economies of scale, they do work here. And so what's the multiple that you usually pay? Is it a multiple on profit, on revenue?
Well, it's the $1 million question everyone asks. The deal structure is that we pay a multiple of the trailing 12 months EBITDA upfront. And then we go into an earn-out structure. Now, reality is every seller and every deal is different. So some sellers, I'll give you two extreme examples. Some sellers say, look, I don't trust the earn-out structure. I've heard horror stories, not from you guys, but there are horror stories out there where people never see their earn-outs. And as a result, and also a lot of entrepreneurs have an iron rod of self-belief. That's why they've done so well. They've just built a business from nothing themselves, often bootstrapped. And so they don't believe that anyone can run their business as well as they can. So at that extreme, they will say, look, I don't trust the earn-out. I want all the money up front. That's one extreme. The other extreme we had a few weeks ago, it didn't come to me, as one of my colleagues. We had a guy who was financially independent and said, look, I don't want any money for the business. Just give me equity in Thrasio. So he believed in us and the journey we're on so highly that he didn't even want any money for the business. He was just like, give me equity in Thrasio. So, those are extreme examples. Now, what I can say is if we pay 100% up front, which we do sometimes, the exit for the seller is almost always going to be less than if they go into an earn-out structure. The earn-out's a risk reward. So if you trust in the earn-out, you will always get a much higher multiple. But there's no guarantee. There is no guarantee. Our track record is fantastic, but it's a bit like an insurance advert you see on television, right? They'll say, here's what we've done in the past, but then it'll say in the small print at the end that future past performance is no guarantee of future performance, and that's true with us, right? So our track record is phenomenal. I mean, our top 10 acquisitions last year grew on average 397%. 397% in our top 10 on average, and then if you scale it down to the top 30, still the top 30 acquisitions still grew on average 226%. So when you map that growth, profitable growth, onto an earn-out structure, we're giving people amazing exits. But you will still find people who don't believe in you. Now, the other thing, by the way, I should say, is that my experience has now taught me that some people who refuse to have an exit often have a time bomb sitting in their business. So for me, I have a big alarm bell when someone won't stick around for an earn-out, because they'll say they don't trust us and they don't believe in earn-outs, but often actually there's something coming downstream that they know about, they don't want to share with us, and so they just want to get the money and get out.
Yeah, that's the same with me. Then people flat out refuse any earn-out. That's a bit of a red flag.
Yeah, absolutely.
However, it's still quite common. We see it as sellers a lot that maybe people just want cash. They don't really want to be involved as well.
Yeah.
They don't want any continued involvement with that. They want to sell it, get the cash, and then just move on to the next
100%.
thing. That they're doing.
So a very common profile is, and you'll relate to this, you start a business and you don't know what you don't know. And then 5 years later, you have a multi-seven-figure business. And you realize you're in something you've lost the passion for, and you've made many mistakes along the way. And you've now got a new idea that's bigger and better, but you haven't got the capital. So a lot of the people, not a lot, a significant number of people I talk to, actually, they want to exit to recapitalize and start again. And so those guys sometimes have a legitimate reason for front loading the deal, and they're happy to give up earn-out final exit valuations because they see more value in capitalizing now to start the new venture. So that's different. That's very different. But when you get these people who go, I just don't trust you, I just want 100% upfront, usually that's, like you said, it's a red flag. Something's not right.
So when we're talking about those people who want just cash up front, I'm curious about the multiple from the EBITDA from the past 12 months profit. Would it be something like 3-4 times the past 12 months profit? Would it be like similar?
I mean, we're delivering exits of 2.5 to 10x for our sellers, and with the earnout model, it's very common to be around 6 times. So I think there's a perception with aggregators that they buy cheap, and multiples have gone up. So, I think an upfront multiple a year ago, 2 would have been common. Now 3 is common, but I can tell you from having many conversations with sellers, it's frustrating because the real money is in the tail. It's in the earnout.
And how does the earnout usually work? Can you give an example of a typical earnout?
Yeah, we share the profit for 2 years after the acquisition. So we peg the trailing 12 months EBITDA at close, and then every dollar above that for the following 2 years, we share 50-50 with the seller. But the seller has to do nothing. We put in all our cash flow, our team of 700 people, and we drive as hard and fast as we can to accelerate that business profitably. And for the first 2 years of that journey, we share the profit with the seller.
But that's a profit after all the expenses, all the money you invest in growth.
Yes, yeah. But we in the sale contract, we cap our operating costs, so we can't artificially kill EBITDA in the name of growing the business. Okay. So we guarantee to, and also we can't keep raising money if we're not growing profitably. Goldman Sachs are not going to give us money anymore. So for the seller and for private equity, we have to deliver profitable growth. And like I said at the top of the call, it has to be around 20% EBITDA every year.
Okay, yeah, makes sense. And in terms of investors, are you public currently, or what? How can people invest in Thrasio?
They can't. It's a private company. There are lots of rumors flying around sort of IPOs. I can't really comment on that. I mean, the one thing that you and I know is that when Goldman Sachs and JP Morgan put money into a privately held company, they're not. At some point, they will probably want to see that IPO or something of that nature. But there are no current plans. But I would imagine it will happen at some point in the future. And the other question I often get, which is maybe related to this, is: do you ever plan to sell the brands you buy? And we don't. Our model is to acquire, grow, and operate. We have no intention to sell off or flip brands and cash in on the growth. We're building a long-term consumer products growth engine.
So you've never sold any of your brands, and you don't plan to, even if they don't fit the like brands that are not in your main niches, when in the main industries you want to be in.
No, we've never sold a brand, never plan to sell a brand. We may, products have life cycles. So, part of a life cycle of a brand is to release line extensions or new products, and we do that. So certain products will be sold through because they're not performing, and the categories become too crowded, and so you launch but fundamentally the brand managers, like any business owner, are charged with being on top of that, so that over time, while certain SKUs go through a product life cycle, there are new ones coming, and overall the growth is there.
And can you tell me a bit about the management? How is the brand management structure? Do you have like specific managers assigned to a brand, or is it all managed by the same team, more or less?
Yeah, I mean, I say this to all the sellers, because it's a big concern when you give your brand to a company like Thrasio. Like, how does it work? It's actually quite simple. Effectively, the new CEO is the brand director or the brand manager. They own the P&L. So at the heart of the business, we have our brand management team. Those guys own the number. And then they have fractional access to this amazing team of data scientists. We've got Casey Gauss, who's heading up SEO. We've got a huge team of creative who are looking at listings, A+ content. Within that, there's a team of animators and video production guys who are giving assets over to the traffic team. The traffic team have an Amazon PPC specialist. We're using Quartile for AI-based PPC management, but there's a human wrap around that. And then we've got the traffic team for Facebook, Instagram, Google, Snapchat. So, the brand manager has fractional access to all of those resources, but they can't be like a kid in a candy shop because they've got to run the business profitably. And that's where they have to find that balance between driving profitable growth in every brand we acquire.
So how many brands would each brand manager manage?
I couldn't tell you exactly, but the brand director a typical brand director has about $100 million under revenue. So it's not so much about the number of brands, it's about the number of SKUs and revenue that they're looking after, because workload's not driven by number of brands, it's driven by number of SKUs and revenue per SKU. So, the complexity is the SKU number and the category expertise. So they're organized into categories and pods, and they are more or less a brand director managing about 100 million in revenue with a team below them.
Sounds good. And can you tell us about maybe some bad deals you've done, some brands that you've acquired and they didn't go very well, and some things that you missed during due diligence or just got unlucky, something like that?
Yeah, I mean, there's two sides to that. One side is the stuff that's out of our control. So early on, we had some big suspensions. We may not have been as good at identifying some of the tactics that were going on. 2018, we were quite a new team. And so, the learning curve was very, very fast at the beginning. So some of the early acquisitions, I think, we weren't as good at operating, and we probably weren't as good at picking the brands that we were good to grow. Then along the way, we've had, like I mentioned earlier, we had one suspension for 56 days on a brand and really big revenue. That hits your numbers quite significantly. And then we've gone into categories that, there's two things I can think of. One acquisition was a weighted blanket. Now, the weighted blanket category, you probably know, is a bit like fidget spinners.
Yeah.
It was like Kickstarter, massive copycat, everyone piled in, huge price competition, and it became a race to the bottom. And I think we bought one of the big weighted blanket brands, but we knew what was coming. So it was a bad acquisition, but it was a smart acquisition because we actually managed to agree with the seller a very fair multiple based on what was happening in the marketplace. The seller was in a bit of panic. Everything was beginning to fall apart, and they had a huge exposure in inventory. And so we took the brand. We didn't pay a huge amount for it because it was clear what the trajectory was. And the niche has stabilized now, so the seller and we're happy with that. There've been no real car crashes. But there are definitely some categories that get harder. We have a brand in the massage guns, which is another one which just took off like crazy, and become very price sensitive, very commoditized. And the team just got creative. We've had to just walk our own talk, and we've come out with new variations with a spec and a price point that's just accelerated the brand again. So I don't think there's no such thing as a bad acquisition, as long as your team have the ability to realize what's going on. And the bigger we get and the data we have, it's very rare for us to make an acquisition that we don't make good.
Makes sense. And so you've gotten pretty good at this recently. What would you say was the biggest advantage, or what really allowed you to learn so quickly and improve rapidly?
I can't take much credit for this. I joined 6 months ago, and prior to that, I was an FBA seller myself. So I know the marketplace pretty well, but I can't take huge creds for what the guys have delivered. But the leadership team. So Stephanie leading up ops, and Brandon and those guys, delivering the traffic. Ken heads up acquisitions, and Mike. There's a very, very, very smart and humble leadership team who just are very good at rolling their sleeves up and working out what needs to be done. And I think, our model is really simple, which is why everyone's now trying to copy it, but the execution is really difficult. And I think what we've got is a leadership team who just know how to roll their sleeves up and get on with it. And that just trickles down in the whole organization. I was nervous about taking what I'd call a proper job with Thrasio. I've been on my own since 2006 as an entrepreneur, and I launched an FBA brand in 2013. Prior to that, I was doing other stuff. So, when my friends, when I told them I was getting a job with Thrasio, they're like, "You're going to get a proper job." They're like, "You're crazy. You're not going to survive. You can't go back into a company." And I say to them, it's not like a normal company. There's like 700 people, but there's a bunch of entrepreneurs just working out how to make this thing work because it's growing so fast. There is no time to build a structure and a process around what we're doing. So you have to be a team of people that can be thrown in and on a common direction. Everyone knows where we're headed. No one quite knows how to get there. And so everyone is just working out how to get there. And it's phenomenal. I used to work in consulting. I work with a lot of Fortune 500 companies and FTSE 100 companies in Europe. I've seen a lot of smart leadership teams and mid-management teams in high growth, hyper growth. I've never seen a team like we've got at Thrasio. And I think that's the secret. Not the secret, but I just think that's how, we're delivering the results we're delivering. And I think that's also the surprise that many who are trying to emulate are going to have, is that it's not easy. It's all about the team, and the team we have is incredible.
Yeah. And so you joined 6 months ago. What was the application process like? How long did it take you to get
I had
hired?
a slightly odd one because Steph, who is the COO, is in a mastermind with me, an Amazon mastermind. And I had a travel brand, multi-seven-figure travel brand. I got killed by COVID last year. So I had to take a step back. I had to sort of get the business out of ICU. I had a lot of inventory all over the world in FBA. And the demand tap was turned off overnight. So I had about 3 months of kind of getting the business out of ICU and hemorrhaging money. I had to let go of the whole team, move stuff out of FBA into 3PL to reduce the costs. And then I was faced with decisions like, what do I do next? And I've given the brand to a couple of buddies who are brand managers. I realized that I wasn't enjoying the fight of Amazon anymore. I've been doing it since 2013, 14. And I reached out to Stephanie, who's CEO, and said, "Look, Stephanie, my brand's been killed. You guys are a rocket ship. I love what you're doing. I don't know that much about acquisitions, but I'm pretty sure I can learn about it. I used to work in consulting. I know FBA." And she's like, "Great. Talk to Danny, who's the president, Ken, who's head of M&A. And long story short, they said, write your own job description. So I wrote my own job description. And 2 weeks later, I joined as head of acquisitions in the UK as we build out Europe. So it was very fast, and
so
there
you
was
just
no real
wrote,
application process.
You just wrote your own job description, and then you basically hired yourself for it.
I didn't hire myself, but yeah, kind of. I had to sort of, I had to sort of pitch who I am and what I can do and where I'd fit. And luckily it resonated, and very quickly that was it.
And you basically you design a job description around being an acquisition manager in Europe.
Yeah.
And you saw that there was a demand that they have, right? So it must have been something that we're looking for as well.
Yeah. And I've got a slightly odd and quite unique background, which probably doesn't work in many places, but it works really well here. Yeah.
And what did you used to do before you got into FBA?
I started off, I did 9-10 years in London working in consulting around leadership. Very specifically, we were working with organizations trying to execute massive change as quickly as possible. The biggest barrier to change in enterprise is usually the people's engagement with the change. And so we would work alongside, McKinsey would often do strategy, and then you'd be left with people doing process and technology. And then there's the people bit. And so we worked with the people to engage with the change so that when they were executing the strategy and the change, they could do it as quickly as possible. And, it was often post M&A, so I had a lot of experience in M&A, but on an enterprise level, where you were bringing two organizations together who were effectively at war. And as you know, most M&A mergers fail miserably. And a lot of that is because, we'd bring two leadership teams together who knew that, 22 we're going to become 11. And it was, but at the same time, they had to make the merger work. And so it was it was pretty dicey. It was fun. It was challenging. But after 9 years of doing that, I had enough. So I decided to do something a bit radical and moved to Spain. I'd had my first child. I bought some land in a place called Tarifa, which is the southernmost tip of Spain. It's a big kitesurf and windsurf capital. It's now actually quite a digital nomad hub. And I bought some land as an investment. The plan was to build a retail unit, rent it out, move on and do something else. I got caught completely with my trousers down in the end of 2007-8 when the crisis hit. My building was halfway up. And so at that point, I wasn't going to be able to rent it. So I decided to open the store myself. So I ended up opening a retail store, selling surf gear, North Face, Patagonia. Next year, I opened a kitesurf school with a 10 times world champion, which was great. Loved it. And during this, I was going back to London doing a bit of freelance consulting because the money was good. And I had an amazing lifestyle in Spain, but a surf store in Tarifa doesn't pay the bills. And I had 4 kids as well, so my bills were mounting all the time. Now, during that time, I worked with eBay's management team, and I saw their strategy deck, and it talked about the move of e-commerce into marketplaces. And then about 3 months later, a friend of mine told me about a course, the Amazing Selling Machine, which was how to sell on Amazon. And I was like, yeah, you've got my attention. I've just seen the eBay's management deck. And so we said, all right, let's do it. We bought the course, we followed the thing, stuck some stuff up on Amazon, and oh my God, this sells, it's real. And that turned into a multi-7-figure travel brand, which was great until COVID hit. I should have sold last year.
How long did it take you to grow that new brand after you've learned?
It was very quick. It was 7 figures within a year and a half. It was 2013, 14 on Amazon was a bit of a sweet spot. It was not a lot of people realized the opportunity at that stage. So all you needed was cash flow to grow very quickly. So the guys that got in at that time with unlimited cash flow, they built 7-8 figure businesses very quickly. Very different environment to now. You could pick a top top 100 bestseller product in any category, and pretty much take them on. Now that would be almost impossible.
So what would you say is kind of the main challenges right now for Thrasio in terms of growth or finding deals or increasing sales?
Yeah, I think now one of the biggest challenges for us valuing is COVID. The COVID bump has had 2 big effects on brands. A, their revenues have gone crazy, and B, a lot of people have priced up. So they've got a trailing 12 months of profit that's completely artificial. So we spend quite a bit of time trying to remodel P&Ls and having a very frank conversation with sellers, because no one knows. There's been a long-term change in consumer behavior. More people are going to stay on Amazon. But for anyone to say that when retail opens back up again, that they're going to sell the same amount of home exercise equipment, I think is probably naive, right? So, but no one knows how much it's going to settle down by. So we spend a lot of time at the moment trying to price fairly, and fair is really subjective because there's no model for COVID.
Yeah,
there isn't. No one's ever seen this before. So that's where we're spending a lot of time. And sellers respect and understand the conversation, but their heart wants to sort of believe that it's going to keep on going. So that's quite a lot of robust conversations around that, which means we walk away from a lot of deals because some sellers believe the honeymoon period is going to go on forever. But generally, our challenge right now is managing the growth. So we have more LOIs going out than we've ever had. We have more deals to look at. And so the sharp end of the business are the deals coming in. When we close and buy an acquisition, a brand, that then has to be operated and the performance has to be as good as it's always been. So, Stephanie and Ops and the M&A guys doing diligence, we're trying to just make sure that everything's calibrated, that if we're accelerating deal flow, that the organization can keep up and keep delivering. That's probably our biggest challenge at the moment. And touch wood, they're doing a great job. And as 3, Josh and Carlos, the founders, and Danny, our president, are amazing. And this is one thing that stuck with me when I joined. They're always like, hire ahead. If you're thinking about it, do it and hire now, because you're going to need it within 3 months. And I've never seen that in an organization. Like I said, I used to work in consulting. I've seen a lot of organizations, but it's very rare that those words are followed by commitment. And in Thrasio, it is, we're always hiring ahead of the curve, so that when the deal flow comes in and accelerates, there's a team there to catch it and operate it. And I think that's probably one of the key things to success at the moment.
And what did the founders do before they started Thrasio? Did they have experience in similar BA businesses and private equity?
Yes, they've both had a few exits. I don't know the exact details. They're savvy street fighters who've had exits. They're nice guys. They're down to earth, but they know what they're doing.
Sounds good. So how many deals do you guys usually look at before you go and buy one? Would it be like 20 or 50 or less?
10 to 20% is what we end up acquiring.
So you look at the 100 deals, you would buy like 10 or 20 of them?
10 to 20, yeah. Yeah.
That's pretty good. All right. And so for many of our listeners, they are looking to acquire their first FBA business or a commerce business by themselves. So what advice would you give them? What are some things that, what would be some things that people often miss or people often don't expect when they buy their first FBA business?
It depends on their background. So for someone that is not a very experienced Amazon FBA operator, that's a really high risk maneuver, because there's a lot to learn, and there's a lot of stuff that you don't get taught in the manual, and you certainly don't get taught. Amazon don't really kind of explain the reality of operating. And then operating on Amazon now, you've got to be good at supply chain and sourcing, because if you don't source the right product, you're dead in the water. It doesn't matter how good you're at marketing. So it starts with product selection. So you've got to be very, very disciplined and very, very good in your sourcing. That's the first thing. The other thing, the stuff that's slightly easier is the creating of the listing, but it needs to get great creative, needs very good copy. That needs to be driven by fantastic keyword research, so you're targeting the right consumer. The other thing that's increasingly difficult, I think, is PPC. Amazon's fastest growing revenue channel, not by total revenue, but growth, was their PPC platform. And it's becoming, cost per clicks going up all the time because of the competition on the platform. And then you add to that they're releasing different widgets and ways to advertise. You've got to be really, really sophisticated in PPC now to do well on Amazon. And it's very hard to be amazing at PPC, amazing at SEO, amazing at creative, amazing at sourcing as a solopreneur. So I think the days of launching a new brand as a solopreneur on Amazon, I think, are getting increasingly difficult for a small operator or acquirer. If you're coming in if you're an existing Amazon operator, you know what you're letting yourself in for. You know what you're looking for. You know that you do your category research. You look at the keyword traffic. You look at the conversion in the account. You look at how they're spending on advertising. You see if they're missing any potential keywords. You do your diligence around that. Are they profitable? If they're not, can you make it profitable? And you decide what it's worth to you, and you make an offer. I think that the risk comes from the guys that are coming in off Amazon, and there's a perception that Amazon's automated, and you just put a listing up and off you go. And Amazon has so many people coming in with high intent to buy, which is true. But yeah, my God, it's a warfare to be on page one for a keyword that gives you some sales volume. You've got to be pretty sophisticated and professional about what you're doing.
Right. Well, thank you, Jim. That's a pleasure to discuss things. I've learned quite a lot from this conversation. Any parting words, or how can people find out more about you and Thrasio?
No words of wisdom, but it's been a pleasure to spend some time with you. Thrasio, you can reach out to me, jim.mann with 2 N's at thras.io, jim.mann with 2 N's at thras.io, or on our website, thras.io. There's a form there, and that will find its way to myself or whoever it is that you want to speak to there, depending on what the inquiry is about.
Thank you. Have a good day.
Thanks, Michael. Take care of yourself. Feel better soon.
Domain Magnate is a leader in buying and selling online businesses with a proven track record of expertise gained from over 300 deals since 2004. To learn more about how we can help you acquire or exit a profitable online business today, head over to domainmagnate.com for more details.